people borrow money this year. One gets poorer. One gets richer. The debt is the same instrument. The outcome is not. This is the difference nobody explains. The debt you know. You are 24. Your credit card balance is $4,800, 23.99% APR. That is $1,150 a year in interest. $96 a month leaving your account and buying you nothing. No asset, no return, no equity. Just the price of having spent money you didn't have. You also have $31,000 in student loans, $340 a month. Of that, roughly $168 goes to interest in year one. You will pay approximately $9,800 in interest over the life of the loan. $9,800 for the privilege of borrowing your own future. This is the debt you were taught about. The kind that costs, the kind that compounds against you, the kind that requires your labor to service it. The first rule: consumer debt is a tax on impatience, and the rate is always higher than it feels. The debt they use. Somewhere across town, a man you will never meet is signing a document. He is also taking on debt, more than you will earn in a decade. And when he signs, his net worth goes up. He is buying a commercial property. Purchase price, $2.4 million. He puts in $480,000 of his own money. He borrows $1.92 million. The property generates $18,000 a month in rent. His mortgage payment is $9,800. Operating costs run $3,100. His monthly cash flow after everything, $5,100. He borrowed $1.92 million. That debt pays him $5,100 every month. The debt is not costing him. The debt is working for him. The second rule: debt is not inherently destructive. The only question is whether the asset it purchases earns more than it costs. The leverage equation. He put in $480,000. The property is worth $2.4 million. If it appreciates 4% this year, the value increases by $96,000. That $96,000 accrues to him, not the bank, him. His $480,000 produced a $96,000 return. That is a 20% return on his invested capital. Not because the property grew 20%, because leverage amplified a 4% gain into a 20% personal return. Meanwhile, your savings account earned $360 this year. You did nothing wrong. You followed the rules. But the rules you were given and the rules he plays by are not the same rulebook. The third rule: the wealthy use other people's money to multiply their own. Most people use their own money to service other people's debt. Why your debt works differently. Your credit card bought groceries, a weekend trip, 2 pairs of shoes. None of those things produce income. None of them appreciate. None of them offset the 23.99% you are paying. His debt bought an asset that produces income independent of his hours. When he sleeps, the tenants pay rent. When he travels, the rent still comes. Your debt requires your labor to service it. His debt services itself. That gap is where the divergence begins. Not in income, not in intelligence, in what the debt was pointed at. The tax dimension. There is a layer that makes it wider still. In year one, approximately $96,000 of his mortgage payments is interest. That $96,000 is tax deductible. He also depreciates the building, a paper loss the IRS allows even as the property gains real-world value. His taxable income from the property after deductions is a fraction of gross revenue. Some years, it is zero. You pay 23.99% on your credit card. That interest is not deductible. It reduces your spending power and creates no tax benefit. He pays 5.1% on his commercial mortgage. The government effectively subsidizes part of his borrowing cost. The fourth rule: The tax code was written by people who own assets, for people who own assets. The deductions available to capital are not available to consumption.
How it compounds. 5 years later, the property has appreciated from $2.4 million to $2.9 million. His equity has grown from $480,000 to $980,000. He refinances, pulls out $400,000 in cash from the increased equity. That $400,000 is not taxable income. It is debt, but it is his to deploy. He uses it as a down payment on a second property. He has not sold anything. He has not earned a salary to fund this. He used the appreciation of the first asset, built with borrowed money, to generate capital for the second. His debt created equity. His equity created leverage. His leverage created a second asset. The machine is running. You are still paying down your credit card. You increased the payment to $300 a month after your last raise. You are proud of this.
The entry point. You do not need $480,000 to begin this. The principal scales down. A duplex in a mid-tier market, $280,000 purchase price, $56,000 down. You live in one unit, the tenant in the other pays $1,100 a month. Your mortgage is $1,450. Your effective housing cost after rental income is $350 a month. You are building equity. You are cash flowing. You are living in an asset. And you used debt to do it. That is not the version he is playing, but it is the same rulebook. The debt is purchasing something that earns. The earn offsets the cost. The equity accumulates. The machine, small as it is, has started.
The return. You are sitting with your credit card statement. $4,800. 23.99%. $96 a month in interest. Buying nothing. You already know this is wrong. You already feel the weight of it. Somewhere tonight, a 24-year-old is also looking at a number. But the number is different. It is a property listing. A duplex 20 minutes from where he grew up. $260,000. He has $18,000 saved. He is reading about FHA loans. 3.5% down. He does not know yet if it will work. He is not rich. He is not connected. He does not have a mentor. He has an internet connection, and one question he has not stopped asking. What if the debt worked for me instead of against me? That question is the beginning. Not the money, not the property, not the loan. The question. The machine starts when you stop asking whether you can afford debt and start asking what the debt can afford to build. It has always started there. It always will.